Welcome to The Explainer. If you really want to figure out what a company is worth, you absolutely have to get its taxes right. So today, we're going on a quest. We're going to uncover the real tax rate, the one that truly matters for valuation.
Okay, let's dive right in. You see a company's tax rate thrown around in the news, right? Or maybe you see it in their own financial reports. Well, more often than not, that number is a total mirage. It looks real, but trust me, it can be seriously misleading.
So you're usually looking at two pretty flawed options. First, you've got the statutory rate. Think of this as the sticker price. It's the official government number. But it's way too simple. It completely ignores things like foreign operations. Then on the other side, there's the effective rate. Now, this one seems better at first glance, but it's often just a mess. It's polluted with all these one-time events that make it way too noisy and totally unreliable if you're trying to forecast anything.
Okay, so if both of those common numbers are junk, what are we supposed to be looking for? What we need, what we're hunting for, is the ideal number, a rate that actually reflects the true ongoing business.
And that number, the one we're after, is called the operating tax rate. I like to think of it as a purified number. It's our way of seeing the tax on a company's core, recurring business operations, because we've stripped away all the noise from things like how they finance their debt or some random one-time event.
So, check this out. This shows the whole idea in action with a made-up company. See, if we isolate only the operating profits, and then we factor in the tax credits that happen year after year, we get an operating tax rate of 21.4%. And look where that number sits. It's right in between that super simple 25% statutory rate and that noisy 17.9% effective rate. This is that stable core number we've been talking about.
Okay, that's all well and good in theory, right? In a perfect world where we have all the company's internal data. But we don't. We're outside analysts. So the big question is, how do we find this number in the real world using only the stuff that companies actually publish?
Well, this is where we have to put on our detective hats. Seriously. Because our single most important clue is buried deep in the footnotes of the annual report, and it's called the Tax Reconciliation Table.
This table, it's like our Rosetta Stone. It is literally where the company explains, line by line, why the tax rate it paid isn't the same as the official statutory rate. And if we analyze all these little adjustments, we can actually reverse engineer our way back to that true operating tax figure.
And the process really just breaks down into three pretty simple steps. First, we start with a baseline number, using that statutory rate. Step 2, we carefully go through that reconciliation table and we look for adjustments that are recurring, the ones that happen all the time and are actually related to the core business. And then finally, we just add only those specific adjustments back to get our estimate of the operating taxes. That's it.
Now, the real key here is judgment. It's not just a formula. How do you tell what's a core, recurring item? Well, you have to think of it like this. You're trying to separate the company's regular salary from a one-time lottery win. You got to look for consistency over time, and you really have to read those descriptions carefully.
Okay, enough with the theory. Let's get our hands dirty and put this into practice with a real-world titan, Walmart.
So here it is. This is Walmart's tax reconciliation table from 2018. And you can see it's a mix of stuff, right? You've got recurring items and one-time noise. Things like state taxes, yeah, that's part of the core business. That happens every year. But look at this line here. Impact of 2017 Tax Act. That is a classic one-off event. It's just financial noise, and our job is to filter that right out.
And here's the after picture, the result of our detective work. We started with that baseline statutory tax, and then we added back only the legitimate operating adjustments. State taxes, foreign income, recurring credits. And what do we end up with? We get our estimated operating taxes, about $4.5 billion.
So what happens when we divide that number by Walmart's operating profit? We get an operating tax rate of 20.3%. Now, get this. Compare that to their reported effective tax rate for that year, which was a whopping 37.4%. See the difference? Our number, that 20.3%, is so much cleaner, so much more stable. It's the one you actually want to use for valuation.
But wait, hold on. We're not quite done yet. If we want to be really precise, and we do, there's one more crucial layer we gotta peel back. We need to go from what's just reported on paper to what was actually paid in cold, hard cash.
And this brings us to a really fundamental question. That tax expense you see on the income statement,
Is that the same amount of cash that actually left the company's bank account to pay the government?
Yeah, the answer is usually nope. And the bridge between these two worlds is this thing called deferred taxes. Basically, they exist because accounting rules and tax rules just aren't the same. So, for example, a company might tell the tax man it's depreciating a new factory really fast to lower its tax bill right now. But at the same time, it's telling investors it's depreciating it more slowly. That timing difference, that's what creates a deferred tax.
So, you guessed it, our detective work continues. It's the same process as before. We have to sift through the company's deferred tax accounts and sort everything into two buckets. One bucket is for stuff related to ongoing operations like depreciation. The other is for non-operating stuff, like getting a tax break from some loss they had years ago. And we only care about that first bucket.
So we take our hard-won operating tax number, we adjust it for the change in these operating deferred tax items, and we finally get to the prize. We can now see that Walmart's actual operating cash taxes were just over $3.7 billion.
Okay, so after all that digging, all that detective work in the footnotes, what's the big payoff? Why does this final number matter so darn much?
The payoff is this number right here. Walmart's operating cash tax rate was 16.9%. That is the single most accurate tax rate you can use when you're trying to forecast a company's future free cash flows. And that, my friends, is the absolute bedrock of any solid valuation.
I mean, this bar chart just says it all, doesn't it? Look at the journey we took. We started with that misleading statutory rate way up there near 22%. We did our work and refined it down to a much better operating rate of 20.3%. But the real story, the cash reality, was a tax rate of just 16.9%. And let me tell you, that 5-point difference from where we started, that is absolutely massive when you're projecting a company's value years and years into the future.
So let's recap the whole journey real quick. Number 1, headline tax rates, they can absolutely fool you. Number 2, your goal is always to find the tax rate on the core recurring profits. 3, your best friend, your best tool for this is that tax reconciliation table. And finally, number 4, for the most precise valuation, you have to convert those on-paper accrual taxes to actual cash taxes.
So, I'll leave you with this final thought. Real understanding, it almost never lives on the surface. So the next time you see a company's tax rate, don't just nod and accept it. Ask yourself, what story are the footnotes trying to tell me? Because I guarantee you that's where you're going to find the real value.